Hey everyone, welcome back to the channel. Today we need to talk about Netflix because this is a really interesting moment for the stock. And honestly, it says a lot about how investors are thinking in 2026. On February 26, Netflix stock jumped as much as 13% in extended trading after the company officially dropped out of a months-long bidding war for Warner Brothers Discovery. And the market reaction? Relief. Big relief. Netflix closed a regular session at $84.59, and then in after-hours trading it surged to over $92 at one point. Meanwhile, Warner Brothers Discovery actually fell about 2%, and Paramount Skydance, the other bidder, rose nearly 4% as it cleared its main rival. So what just happened? Let's break this down in simple terms. For months, Netflix had been engaged in a bidding war to potentially acquire Warner Brothers Discovery, but the price kept climbing. Paramount Skydance sweetened its offer to $31 per share, valuing the total deal at around $111 billion. And at that price, Netflix's co-CEOs, Ted Sarandos and Greg Peters, basically said, this is no longer financially attractive. And honestly, that's exactly what investors wanted to hear. Because when companies get into bidding wars, especially in media, things can get dangerous. Massive acquisitions often mean overpaying, taking on huge debt, integration risks, management distraction, and Netflix investors did not want the company turning into a traditional Hollywood studio with cable networks and theatrical distribution headaches. By walking away, Netflix avoided all of that. But here's the part that makes this even more interesting. Warner Brothers Discovery now owes Netflix a $2.8 billion breakup fee. That's an immediate cash infusion. And what did Netflix announce alongside this decision? They're resuming share buybacks. That's huge. When a company buys back its own shares, it reduces the supply of stock in the market, which often supports the price, and increases earnings per share over time. So instead of spending $111 billion on a risky acquisition, Netflix keeps its balance sheet stronger, collects $2.8 billion, and can return capital to shareholders. That's why the stock surged. There's another angle here, too, regulatory pressure. This deal was already facing scrutiny from the Department of Justice and even a probe call from 11 state attorneys general. That kind of regulatory overhang can drag on a stock for months. By walking away, Netflix removes that uncertainty completely. Now let's talk fundamentals, because this is what really matters long term. Netflix is guiding for 2026 revenue between $50.7 billion and $51.7 billion. That's 12% to 14% growth. They're planning to invest about $20 billion in content in 2026, but through organic growth, not acquisition. And the ad-supported tier, that's expected to accelerate toward $3 billion in revenue. So now the valuation story becomes cleaner. Solid double-digit revenue growth. Expanding ad revenue, strong global subscriber base, share buybacks, no mega deal debt. Personally, I think this was a very mature move by management. It shows discipline. And in this market, discipline is being rewarded. Now, let's talk about the big question. Where could Netflix stock go from here? Of course, this is just my opinion, not financial advice. Over the next 12 months, assuming Netflix delivers on its revenue guidance and ad growth continues to ramp, I could see the stock trading in the $105 to $120 range. Why? Because investors are now re-rating the company as financially disciplined with cleaner growth, rather than as a risky acquirer. Over the next 5 years, it really comes down to three things: global subscriber growth, advertising scale, margin expansion. If Netflix continues compounding revenue at 10 to 15% annually and expands operating margins through advertising and buybacks, I think a $180 to $220 stock price in 5 years is achievable. That would imply strong, but not unrealistic multiple expansion combined with earnings growth. But here's the key risk. Competition is still intense. Streaming is not an easy business, and content costs are massive. The difference now is that Netflix is choosing focus over empire building. And right now, Wall Street loves that. So what do you think? Was walking away the smartest move Netflix could make? Or did they miss a transformative opportunity? Let me know in the comments. I read every single one. If you found this breakdown helpful, please hit the like button. It really helps the channel. And consider subscribing if you want more stock analysis explained in a simple, no-hype way. Thanks so much for watching, and I'll see you in the